Hello, welcome to this edition of Fed Watch. Today is December 15th, 2023, and the Fed decided this week to leave interest rates, the Fed funds rate, alone, holding it flat. But it gets a little bit more interesting than that. They even talked about lowering interest rates in 2024, something that we've been talking about for quite some time now as probable. They're talking about 3 to 4 different rate cuts, each at 25 basis points. That's the overall storyline. Consensus is 75 basis point decline in interest rates, Fed funds rate in 2024. 4 of the voting members said 100 bips, and 1 said 150 bip decline in 2024. The good news is that they'll be coming down, and that's good news. Bad news is it's not going to be enough because while the Fed has not raised their interest rate, we've seen a decline in the 10-year bond yield. So now that the inverse yield curve spread has widened to 151 bips as of yesterday's close. So we need more out of the Federal Reserve if we're going to right size the yield curve. And they're giving themselves room to be able to do that. Looking at their own forecasts for 2024 and 25, they see the core PCE rate coming down to 2.6%, 2.3 to 3.0 is the actual spread for 2024, and coming down to 2.0 to 2.6 for 2025. We think that rates may come down a little bit, inflation may come down a little bit quicker than that, and that could give them some latitude to lower those interest rates even more. Frankly, I'm a little bit surprised that the 10-year bond yield has come down of late. Certainly the government's need for funds has not diminished, and I haven't seen any data suggesting that the Federal Reserve is stepping back in to soak up some of that demand by supplying some supply, really. So it could be temporary. We'll keep an eye on it. I had been hoping really that the 10-year bond yield was going to stay up there, and while the Fed lowered rates, it'd be that much easier to get out of this inverse yield curve situation. Time will tell. Another update this week was the producer price index for November came out, and the PPI showed a decline, year-over-year decline. So we've had 2 consecutive months now where the PPI is running below year-ago levels. The 12-month moving average has ceased to rise, and we expect the PPI overall to be in a negative trend for 2024 and into early 2025 as well. That means that the big stick in all this is going to be labor, and the Fed sees, and we see that the wage inflation is abating, that unemployment is edging up. The Fed seems to be pretty sure they're going to nail this proverbial soft landing. And so far, can't blame them for thinking that if all they're looking at is retail sales. But new orders continue to be weak. We still see interest rates biting into capital goods expenditures or new orders. So there's plenty of caution signs out there as far as we are concerned, including the manufacturing, as I mentioned before, not only new orders, but production now declining below year-ago levels. That's of concern, but I'm sure they're counting on the service sector keeping overall GDP from going into overt recession, as are we. We don't have overt recession. But for our manufacturing clients and our distributors that are involved with durable goods and the manufacturing side of the economy and distribution, this is going to be a rougher ride than the Federal Reserve really cares about. They're looking at the broader GDP. So you need to be a little bit more cautious about 2024 than the headline news is putting out there regarding these Fed projections. So capping it up, we got decline in interest rates coming at us for 2024. It sure looks like, although the Fed Reserves are right not to lower those interest rates, we think they will, that things are going to go smoothly enough in terms of softness that they're going to lower the interest rates, softness being in terms of inflation. We remain concerned and are forecasting industrial production manufacturing will be in decline in 2024. And if we get some additional softness in pricing because of that, then we may see that 100 to 150 bip decline in interest rates, which is going to be the minimum that we need to close the gap on this inverse yield curve, which we maintain still needs to be done in order to get as vibrant an economy as we can get for 2025. So all that being said, we got some good news. It's the Christmas season, so it's a good time to get some good news and get a little present from the Fed. Thanks for watching this edition of Fed Watch. We'll see you next week.